The US economy is being hit by multiple inflationary forces simultaneously right now, ranging from global geopolitical tensions rising to a number of concerning events happening domestically. With the Federal Reserve now starting to aggressively cut interest rates and quantitative easing beginning to power back up, we could be heading for a total nightmare scenario. And what's even worse is that we are on the exact same inflation path as in the 1970s, where the exact same mistakes were made, which ultimately resulted in inflation surging for a second time to even higher highs and a prolonged period of suffering with stagflation. The growing conflict taking place in the Middle East is just one big thing that is putting pressure on global supply chains right now, and the consequences of the continued period of fighting and missile strikes continues to rise. Iran fired hundreds of missiles at Israel on the 1st of October, with Israel saying that there is going to be a serious and significant response to the attack. Oil prices have climbed by over 12% since this attack took place, as fears are mounting around the disruptions that this conflict will have on oil production, especially considering that Israel has even stated that they are considering striking Iranian oil facilities directly. Iran is a major global oil producing country, ranking 7th largest in the world, and responsible for producing just over 4 million barrels of oil a day, which is approximately 4.9% of the 83 million barrels of oil that are produced every day globally. Disruption to global oil supply will be even worse if the conflict escalates into a prolonged war within the Middle Eastern region, and a senior official of Iraq's PMU just warned not a single drop of oil or gas will leave the Middle East if there is a war. Winter is near for Europe. Iraq themselves produce even more oil than Iran, ranking 5th in the world at 4.45 million barrels a day, and the two countries between them produce more than 10% of the world's daily oil supply. Iran and Iraq are close allies, so even if we see oil production disrupted in just these two countries, let alone the rest of the Middle East region, this is still a very significant portion of the world's oil supply being crippled. But another scenario that would have even more serious implications, according to Andrew Lipow from Lipow Oil Associates, is if the Strait of Hormuz gets shut down, which would remove supply and likely cause the price of oil to surge. 30% of the world's oil passes through the Strait of Hormuz, so any shutdown would have a catastrophic impact on oil supply and the price of energy in the run-up to winter. Oil is used in one way or another for almost all goods and services in the economy, whether that is part of the materials used for production or just for shipping and delivery. Therefore, as oil prices go up, the cost of production for goods and services goes up too, leading to higher prices and higher inflation. And here we can see that there is a definite correlation between crude oil prices and CPI inflation throughout history, and if anything, the link between the two metrics has become even stronger over the last decade. A growing global money supply from major economies ramping up their quantitative easing policies is another major trend that is putting upwards pressure on inflation both globally as well as specifically in the US. The total money supply across the major global economies, the US, Europe, China and Japan, has surged by $7.3 trillion in the last year, the largest one-year jump that we have seen in 3 years. Now, this recent spike that we have seen is mirroring the increase that we saw in the first half of 2020 during the initial pandemic response, and now puts the global money supply at a new all-time high of $89.7 trillion. Now, in the US specifically, the M2 money supply has grown by over $450 billion in the last 12 months and is now firmly reversing the brief decline in money supply that we were seeing between 2022 and 2023 during quantitative tightening from the Fed. And China has just rolled out a big stimulus package as well to boost their economy, including cutting interest rates and mortgage rates, adding liquidity support for stocks, and also reducing bank reserve requirements. Now, it seems that central banks across the globe just cannot sustain quantitative tightening anymore and have had to turn the money printer back on. And this is an extremely concerning sudden change of strategy, as we have historically always seen inflation follow the money supply, but lagging behind by a couple of years, and an extremely obvious example of this correlation was just a few years ago in the fallout to the pandemic. The US government pumped money into the economy in the form of stimulus, resulting in a massive surge in the money supply, peaking in early 2021. As this money flowed through the economy, prices of goods and services started to rise, and with it so did inflation, where we ultimately saw CPI peak in summer of 2022. So the fact that the money supply globally, as well as specifically in the US, is now skyrocketing again, does suggest that we are not far off seeing another big spike in CPI, which is already above the 2% target and never actually dropped below this threshold. And we've also just seen over 50,000 port workers across the US go on strike for the first time since 1977, with these ports handling nearly 40% of all US imports. JP Morgan had estimated that the strike was costing the US economy up to $4.5 billion a day. However, workers have now agreed to end the strike after just 3 days, thanks to a new blockbuster 62% pay package increase. Now, this agreement solves the problem of ports being shut down, however, has birthed a brand new problem of rapid wage inflation. This new pay package will raise the base hourly rate for ILA port workers from $39 to $63 over 6 years. And with port workers demanding higher wages, we will see the cost of shipping increase, and companies are likely to offset these higher costs by increasing the price of their products. All of these inflationary forces hitting the economy at once are enhanced even more so by the fact that the Federal Reserve has already started aggressively cutting rates, raising the question on whether these rate cuts are premature. Starting to cut rates prematurely was exactly the mistake that was made in the 1970s, and the path that we are now treading today is eerily similar to the one that we saw during the 1970s, both in terms of Fed decision making as well as how closely the CPI data is mirrored when both time periods are charted on top of each other. The 1970s was a decade which saw inflation surge after excessive quantitative easing, followed by steep interest rate hikes to fight off this inflation to an initial peak of over 11%. Once inflation had started to come back down though, the Fed started to drastically cut interest rates as they thought that they had beaten inflation. However, shortly after this, it began to surge again to ultimately end up reaching an even higher peak. With all of the inflationary pressures hitting the economy right now being considered, it is reasonable to think that there is a good chance of us continuing to tread this same path as during the 1970s, seeing another major inflation surge starting within the next year. This is just one problem that the Federal Reserve is facing right now, and they are already starting to panic about some of the recent economic data that is coming out in the US, with companies also giving warnings to investors in their recent earnings reports on deteriorating trade conditions and weakening consumer strength. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.